Hello there, this is forexbrokers.net, and today's video talks about money management, one of the most important things in trading and in investing in general. Money management deals with how to allocate resources in a trading account or in a portfolio in such a way to make the most of the market moves. There is always a risk in everything, not only in trading. There's always a risk in life. I mean, you go and take a cab, for instance, and there is a risk that you may not reach your destination. Or you go on the street and you try to cross the street, or there is a risk that everyone takes on whatever we do. We eat something and maybe the taste is not good, and so there is a risk in everything. Of course, the idea is to mitigate the risks in such a way that we will end up on the winning side. In investing or trading, risk, let's put it here, risk the idea, or money management or risk management, the idea behind the two concepts is not to eliminate risk. Well, if we want to eliminate risk, then we don't need to trade. I mean, the only way to avoid 100% risk when trading is not to trade in the first place. But the idea is to trade and to apply the resources and the funds in a trading account in such a way to make the most of your account. Now, I want to show you something. I want to discuss one important principle. Let's say that we fund a trading account, or you have a trading account with worth of, let's try to do it here, worth of $1,000 or $5,000. Let's just put a number here, just like that. And then on any given trade, there are so many currency pairs and markets on any broker. You may trade the euro pairs, there are so many of them, Canadian dollar pairs, Japanese yen pairs. You may trade commodities, gold, oil, CFDs in terms of shares, indices, indexes, whatever you may trade. But the principle, or the basic money management principle, is to never risk more than 1% of your trading account on any single trade. And in this way, if you do so, for instance, on a $5,000 account, imagine this is the equity of your account, 1% would be what? 1% would be, if 10% is 500, 1% would be 50. So you risk on any given trade $50. Now let's say that this is the euro and Japanese yen we see here on the daily chart, and this is the price section on the euro and Japanese yen. And we actually see that the euro and Japanese yen here is trading with a bit of a bearish tone, despite the fact that in the last day moved higher. Why a bearish tone? Well, if we look at this area, it more or less put a double top into this area. When trading the FX market, you should think of being a bit more flexible when interpreting classic technical analysis patterns, because the areas, because of the high volatility in the FX market, there is not a specific level to interpret, but more or less an area. And double top, for instance, translates into the market trying once the area, failing, tries twice, fails again, and looks like the letter M. So, well, this one looks like the letter M, like this is the first half of it, the second half of it. And then to trade it, if we take a trend line and we try to mark the so-called neckline, where we want to see the price breaking low, like this. Let's go only for the real body of the candlesticks. Let's make it a bit different. Let's make it with a different color in blue. So this would be, let's say, our entry level. So we want to go short euro US dollar. By the time it reaches this level, this is euro and Japanese yen, 124.61. It's something like 90 pips lower. Well, this is the ECB day. The ECB is expected to deliver its interest rate decision in something like a few hours from now, and it may be that the euro and Japanese yen react. We don't want to take any chance by trading the market. We want to see the pattern. We have a trading plan. We want to see the pattern breaking low. double top or a double bottom has a measure move. The measure move is the distance from the area, not with this one, let me delete it, from the area from here to here, projected by the moment that the market breaks, something like this. So this will be our take profit. So we want to go short here, and we want to exit somewhere around here. So shorting 24.60 with take profit at 22.44. That would be our exit. Now, how to do that? And how to establish the parameters of this trade in such a way that we should not risk more than 1% of the trading account on this trade. This is the daily chart, so we need somehow of a bigger stop on this one. Let's assume that we will be filled on the downside on this trade right here, and this would be the high. And then at that point in time, we need to place a stop loss order at this previous swing high. This will be our stop loss. So this is the risk, and this is the reward. The risk should be $50. The thing to do is to measure this distance from here to here in terms of number of pips. So this is 24.66, this is 25.64. Let's say, for the sake of simplicity, these are 100 pips. If this is a 100 pips distance, then in order to risk $50 for the entire trade, if we are going to be stopped by the time that we are filled here, and what we need to do is to adjust the volume in such a way that if the stop loss is reached, we won't lose more than $50. And therefore, on the Euro and Japanese yen, for instance, 0.1 lots represents $1. So if the market moves 100 pips against our entry, it will be $100. So trading 0.1 is too much, but trading 0.05, so we trade 0.05 as the volume, 0.5, means that if the trades, by the time that we are filled here, if the market is filled and bounces back all the way to here, we lose $50 as we trade 0.05. If it reaches the take profit, we make what? If this is the risk, then the reward exceeds 1 to 2, and we make $100. Let's make actually more than $100, probably 100, more or less 125, 120, $125 would be our reward. So this would be a trade that respects a risk-reward ratio that has a risk-reward ratio of 1 to 2.5. The bigger the risk-reward ratio, the better. Why? Because no matter how more or how much the euro and Japanese yen declines, you will only risk $50. This is the basic rule in money management. Many others exist. But if you follow this simple rule, by risking only 1% of a trading account and sitting for the target of minimum 1 to 2, 1 to 3 if you can, 1 to 4, then you'll be on the safe side of the market. Why? Assuming that you trade or you take 72 consecutive trades where you risk only 1% of your trading account, then you still have half of your trading account available. But on the other hand, if you end up losing 72 times in a row, maybe you need to develop a bit more of your technical analysis skills or fundamental skills. Let's assume that the market goes and takes the stop loss. So the account will have a new balance. Instead of 5,000, it will have 4,950. So then for the next trade, the risk will be $49.5, 1%. Thank you and have a great day.